Hey folks, Nick here. Looking at how to short stocks or tickers, not necessarily stocks, anything safely, because shorting is a hazardous event now on Wall Street because of Main Street. The Reddit phenomena or mentality is so wild right now that it's the Wild West, and the SEC is not doing anything on any side. So both sides are cheating now, and it's out in the open, and nobody cares. So it makes it dangerous. So situations like AMC and GME are a daily occurrence in spurts. And so somebody that actually still shorts like the old school way, whew, stones of steel, man. Not for me. I would not put my future or my prosperity in the hands of fools. So why do it the old-fashioned way? So here's how it happens the old-fashioned way. Let's say you wanted to short whatever. This is the XLF. Clearly, this is not an obvious point of entry, right? This is just no judgment over the quality of the companies inside the XLF. Banks are solid financial statements, but from a trading perspective, this is not an obvious point of entry, right? Pandemic, crash, recovered, doubled. So, not the obvious point of entry. If somebody wants to short it, I get it. So the typical way of shorting it, somebody would borrow 100 shares and at current price, and they sell them. So I'm basically selling something I don't own. By the way, I'm not condoning doing this. This is what I don't do. And I put the money in the bank. But now I'm on the hook. I need to return 100 shares. If I was right and the stock is going to fall, whatever it is, and it does fall 10%, I buy it back to return my shares. I only need to return not the money, I need to return the count of shares. So I buy them back at the so-called lower price. The difference is my profit. That's how the shorts work. They only need to be right once. But if they're wrong, they're losing for as long as the price is rallying. So you have unlimited potential losses. For me to invest in something with unknown loss potential is ridiculous. So when I invest in something, I buy it, right? My maximum I could lose is 100%. Okay, I accept the risk of, if I risk 500,000 or $500 or 1,000 or 10,000, depends on whatever it is, I accepted the risk. But to say, okay, I'm going to be at risk here and I have no idea what it's going to be tomorrow or in an hour, nope, not for me. So there is a way to do it using options. The option gives you an outlet to short something with finite risk, with a known amount of risk. The selling part, people can still be short using options crazily by selling a naked call, which I never do. I don't think anybody should do, because you're effectively short the stock. Because when you sell a call, you're committed to delivering stock at that price. You might as well have sold it outright. Whereas if somebody wants to sell a call spread, then they limit that risk. Then I get that. And the idea of selling a call spread is attractive to me because I don't need a drop to win. I just need it to stop rallying. So that's one way. The easier, more straightforward way is to buy a put. So what's wrong with buying a put any day? Well, there are nuances. Like today, what is today? June 1st. The VIX rallied as the market rallied, or parts of the market rallied. So if I buy anything, that means I paid a premium, because the VIX, the fear factor, is priced off of the options. That means that everything in the options was more expensive today than yesterday, 7%. So I paid a premium if I bought one thing. Like if I bought a put, if I bought a $35 put, I paid a premium. In this case, I'm just picking on the XLF. So how can I mitigate that risk? How can I eliminate that increase in volatility premium price that I'm paying? I would buy a put spread, because that involves buying a put, say to 35, and selling a put lower, say to 32. These are not recommendations, these are examples. So now I bought something and I sold something. I overpaid and I overcollected. I neutralized that effect. So the VIX spike, I'm no longer paying a premium. I literally spread my risk. It's called a vertical put spread here in this case. It's debit because I paid for it, because the one I bought was more expensive than the one I sold, but at least I got something in at the expensive rate. So if tomorrow the VIX crashes, both crash, volatilities. So both lose that extra premium. Therefore, I didn't get shellacked just from that perspective. Sometimes you get the price move that you want, and then you end up not making money because of that effect. The VIX drops, or the implied volatility in that particular stock for earnings, for example, goes away. And suddenly, where's my premium? I paid for the put. Well, you overpaid for your put, and now it's gone back to real life. And a lot of that profit you would have made from the move you guessed right is gone. So a debit put spread, that's the point of this video, is a very mild way to bet downside on something. Why do I mention it here? People are saying, how can I hedge my account? A, you can book some profits and get a little bit leaner. B, this is the S&P. This is not an obvious point of entry, and it could be vulnerable to slides. We could have a little. So these are weekly. So 3 weeks ago, we had a little dizzy, did we not? It felt like the end of the world because it was concentrated. We had it again a week thereafter. Then we recovered, and now we're back to all-time high. What would stop it from happening again? Nothing. We could do this, but we can also do that. So I have a car, I have a house, I have a body, I have insurance on all three. If I have thousands in the stock market, why don't I have insurance when we are at all-time highs, right? So the easy way to get insurance is to sell a call spread in the SPX, for example, and even if it loses money, the point of insurance is that it loses money. But it does its work in the oh schmutz moments. That's the point. If you're making money off your insurance on the car, that means you crash your car. So the logical thing to do is to get a little bearish somewhere to put some balance in an all up, all out, all in portfolio. Easy way, a $10 debit put spread in the SPX or the SPY or the whatever. Depends on what you're long. If you're long tech, I would choose the QQQ. If you're long AMC and GME, I would choose the IWM or RUT because that's the small caps and they're all in there. But the general statement is the SPY. Everybody knows it. $10 wide. What do? I pay $3 is the sweet spot for me on a $10 wide spread. So the upside is $7 per contract. So for one contract, I pay $300. I could make that $700. I'm not, quote, making it because it's offsetting losses if I'm long other stuff on a bad day. Correct? All right. So when I buy insurance, I don't game it. If I start getting profitable, I don't book it because I probably am going to use it. And if I change my mind, I'm comfortable with the upside scenario, or I close my stocks, I can buy it. I can sell it for partial gains or losses. So the concept of getting cautious doesn't have to be that I switch to being a bear. It just means to be, in fact, it's bullish. Because if I was a bear, I'd sell out of everything, right? So if I buy a little protection, that means it's kind of bullish because otherwise I'd be out. So these three candles were too fast. We still have a gap here. And by the way, I forecasted these and I shared it with the members, and we were ready long from 395-ish, and then it gapped up to through 398, and woo, up we goes. We were long, the group. So it's not like I'm a bear all the time. I saw an opportunity, and it came, and it over-delivered. Same deal at 378 too. I think this one here. Somewhere it flashed 378 one time. I think this one of these here. Anyway, back there. What I'm saying is, it's not a bearish opinion I'm expressing. It's an idea to put some balance in the portfolio. All right, this video is already longer than I wanted, but one point led to another. If I wanted to short to put some balance, the options market offers solutions. So if you've never seen what an options market looks like, this is E-Trade's platform, and these are called option chains. I would pick one. I wouldn't pick June. I would probably go to July because time is sensitive. And if I wanted to buy a debit put spread, so these are puts on the side, these are calls on this side, I would choose a put spread where I would buy one and sell one. So buy one and sell one, space them out however I want. I pay $700 for this one. I collect $600 for that one. That puts me in one type of put spread. I can take it down. or bring it up. It doesn't matter, as long as I put it in a place where it makes sense to me. And I shared with you earlier my parameters for such a situation. And the idea is that we could revisit to close this gap and it would change nothing. In fact, what is this? 10%? 20% would bring us back to the bottom of the channel on a weekly basis. 10% would just revert us to the mean. Red, blue, that's a regression line. Bulls are still in charge in both scenarios, meaning they will buy the dip. If not here, here, or here. I will buy the dip here. In fact, I will put it right now. Why isn't it not there? Dude, TradingView is deleting my updates. Okay, so actually I'll buy it here. Also. And here. All right, you get the point. Nick signing out.